This week on Wealth Track, great investor Mark Headley discovered the investment allure of Asia early on. Now the pioneering chairman of Matthews Asia Funds warns Americans could be missing the boat on future growth unless they change course. Mark Headley on investing in Asia is next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. The Wintergreen Fund, your home for global value. Rosalind P. Walter and the Dreamin Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Emerging markets have been the darlings of the investment world for the last 2 years. While investors were fleeing stocks in favor of bonds overall, they made an exception for stocks in the developing world, at least until now. In what Bank of America Merrill Lynch's chief global strategist Michael Hartnett is calling the Great Rotation, emerging market stocks, along with other past winners such as gold and small cap stocks, have been fading, while yesterday's losers, European stocks and global financial shares, are leading. Developed markets have outperformed emerging markets for 5 straight months. Investors are taking note by pairing their positions in emerging market equity funds while raising them in large cap stock funds. Now, there are some fundamental reasons why investors are skittish about emerging markets. Political unrest in the Middle East is one, and there are significant economic challenges. A slew of commodity prices have been setting records in recent weeks, including copper, cotton, and wheat. Higher global commodity prices take a much larger toll on low-wage countries than they do on higher ones. As you can see from this chart on inflation in China, prices which fell during the financial crisis have been rising rapidly. Inflation is now running close to 5% year over year. In response, China has been hiking interest rates. A week ago, it raised rates for the 3rd time in 4 months. Just about every other developing Asian country is doing the same in an attempt to contain inflation, which will mean slower growth down the road. Now, that said, Hartnett and his team at Bank of America remain long-term bulls on emerging markets because of their still relatively strong growth outlook and higher bond yields. By one estimate, China's GDP will be around 9% higher this year and next. We can only wish. Now, China's growth has propelled it to yet another milestone. This week, it was reported that China's economy surpassed Japan's to become the world's 2nd largest. Last year, China's GDP reached $5.88 trillion versus Japan's $5.47 trillion output. The two combined are still considerably less than the U.S.'s GDP, which grew to $14.66 trillion last year during a relatively weak recovery. But despite the rising economic clout of China and other emerging markets, American portfolios remain heavily skewed to American markets, which is a bone of contention for this week's guest. Great investor Mark Headley is a pioneer in Asian markets, where he's been managing portfolios from Matthews Asia Funds since 1996. Including the Matthews Pacific Tiger Fund, a Morningstar pick with a 10-year annualized return of nearly 15%, far ahead of its peers in category. Headley has stepped back from active portfolio management and is now overseeing the firm as chairman of Matthews International Capital Management. I began our interview by asking Headley why he feels Americans' approach to international investing is frequently mistaken.
The point we've been trying to make is America makes up 25 to 30% of the global economy, 30 to 40% of stock markets, depending upon how you count capitalization. And yet the standard American advice is you can have 20% international. And then that international piece, you have emerging markets, but there's usually not a lot of commitment to that emerging markets piece. When it's hot, people pile in. When it's cold, they tend to pile out. So it's very tactical. And I think this just defies good long-term investing logic, which, as I've tried to point out, we tend to be very good investors in the United States. We take long-term positions in large cap, small cap, value, growth, but then we tend to be much more flavor of the month when we go international. And somebody who has a couple hot years or a sector that's really good, we pile into, the winds change, we're out of it, and that isn't really the way to be successful in any long-term equity investing. We're too opportunistic. We treat it as not part of our core investment theme. Whereas I would argue, if America's maybe as much as 40% of the market cap, being 50, 60% in your American investing, being at least 30 or 40% in your international investing, this is a huge component of your long-term equity investment, and it should be treated very, very seriously. And it doesn't mean that any one solution is better than the other, whether you're passive or active, but to really make the commitment to find strategies you believe them, have them fit in with your overall investment philosophy, and stick with them, rather than seeing it, I'll buy China this year or Brazil, or now we're off to the Middle East, and bouncing around the way people used to with tech stocks.
Let's talk about Asia, which is your specialty. And aside from China last year, Asia stocks, the Matthews Pacific Tiger Fund, did extremely well, for instance. So how should we be viewing Asia as American investors?
Well, as I always say, it's a huge region. So there were areas that were particularly hot, and we had great returns from a number of the Southeast Asian markets. Thailand, Indonesia had terrific years. India had a great year. And China was actually relatively flat. Korea came on strong more recently. So it's a very mixed region. There's a lot going on. But I would say overall, it's a time to be cautious. I mean, this is, we hit tremendous valuation lows 2 years ago in the crisis. The markets have responded fabulously since then. Thank you very much. If you've made those great returns and Asia's outperformed other areas of your portfolio, it's a perfectly reasonable time to reallocate to other regions, whether it's in the US or somewhere else, to take some risk off the table. On the other hand, Asia is generally not overly expensive, and where it was looking a bit frothy, like India, we're seeing double-digit pullbacks already in the first 6 weeks of the year. So I'm happy to see those markets retrench and get a little fear in there. I think that there is no reason to run away from Asia, and there is no reason to run into Asia, frankly, at this moment in time. I think the uncertainties about the global economy and the real pain that developing economies are feeling around the world from food inflation, from commodity inflation, it really hurts these countries in general, unless they're a big commodity producer, which most Asian nations aren't.
So talk to me about the threat that rising commodity prices, and of course what's happening with that means rising inflation, and that the central banks, China for instance, are very much responding to that by raising interest rates, trying to slow down inflation and economic growth. How much of a threat are these moves to the growth of the region?
Well, I think they're trying to engineer, and particularly in China's case, they're working very hard to engineer a soft landing after pumping a ton of money in the economy during the financial crisis, after loosening things up, getting a lot of fixed investment. They're trying to wind that all back down to a more sustainable rate. I think the odds are they'll do it. They have a reasonable track record, but it's hard. There's a lot of uncertainty, and right now we are being hit by these factors like oil prices moving up, food prices moving up. There's a huge potential drought. We're getting warning signs in North China that hits their wheat harvest. This can have a huge impact, especially on poor rural populations. For an urban manufacturing employee, probably not a big deal, but if you're living out there and your fertilizer prices go up 30 or 40%, and there's a drought, this can be just devastating. And I think that this is the life in many developing countries. There's nothing extraordinarily unusual about it, but I do think there's a fair amount of uncertainty. I think that given the gains we've had in the last 2 years, it's just a time to be careful, to be cautious, to stay well diversified. There isn't an opportunistic reason to jump into equities when interest rates are moving higher. I think on the other hand, I don't see any reason to believe that Asia isn't going to outgrow most of the rest of the world over the next 5 to 10 years. I think that trend is still fairly solid.
We have, as individual investors, have a lot of different options on how to invest in many markets. I mean, in the emerging markets in Asia, for instance, Matthew's Asia funds, you've got, the Pacific Tiger Fund, for instance, which invests in Southeast Asia, ex-Japan. But then you have country funds as well. So how do we decide when it's appropriate to invest in a country fund, when it's appropriate to invest in a larger fund that invests in, in an entire region? Help us make those decisions.
I have long argued that it takes a pretty sophisticated investor to go into a single country fund. I've argued in general that most single country funds are more like owning a U.S. blue chip stock. That if you'd go out and buy GE or some other large U.S. company, you can take on the risk of buying a China fund, but you should have a reason why you want to do it. There should be something compelling. You've visited it, you're impressed by it, your company works with it, you know something about, you believe in it. It shouldn't be just, I'm going to make a lot of money off China in the next couple of years. I think for 90% of U.S. investors, diversified Asian fund is as far into the region as you need to go. And that if you want to add that single country exposure, it's because you really have some special interest. So diversified regional funds are a really nice way to offset what is really, in my mind, the overemphasis that you see in most international funds on Europe historically and developed markets in general. They'll have much more in Canada than they'll have in China. And you can add emerging markets funds and balance it out any way you like. There's diversified emerging markets funds, dedicated regional funds, and the large international landscape funds. They're all good ways to go. And knowing what's in those portfolios and how the managers run those portfolios and mixing them together in an appropriate way, again, very much like we would put a value fund alongside a growth fund in the US, small cap versus a mid cap versus a large cap. Get a mixture of approaches. Don't put everything into growth. Don't put everything into value. There are times when strategies, whatever it may be, don't work well for a period of years. And so I just really encourage people to think in terms of, when you only had 10 or 15% internationally, you could put it in a couple funds and theoretically let it go. But when you're talking a third or more of your equity portfolio, you really have to think of it, how do I balance off the different ways I'm getting exposure? What are the choices? What do I have an affinity for, and what makes sense? And that's a big educational challenge that I think Americans, need a lot more access to, need better ways to approach. And
this is part of your message as well, is that we need to take the sophistication as U.S. investors that we would apply to the U.S. market and apply that to emerging markets as well, including Asia.
What drives me nuts sometimes is that you hear about the emerging markets manager, the international manager, who basically claims that, hey, I've got this huge wide landscape, and I'm going to jump around, and I'm going to be in the right place every year in the right time. And I think that most U.S. investors have learned that promise doesn't work in our own market, that somebody who's always going to be in the right trend or the right place, that you're much better off with somebody who says, listen, this is my strategy, this is my approach. I'll make adjustments. I may be opportunistic from now and then, but here's my core approach. This is what I do. And it doesn't involve predicting what interest rates will be in China at the end of 2011. It doesn't say, oh, I know what inflation's going to do to India.
Is there any part of the region, is there any sector, is there any country that looks that looks particularly attractive right now?
Well, always on an individual stock basis,
right,
you can find exciting opportunities. And there's always sectors that are out of favor. And there are always countries that are mired in a rut. And Japan, the largest stock market in Asia, still more than 50% of the Asia Pacific Index, as MSCI defines it, has really been the great disaster of the last 20 years on an index basis. But individually, there are great companies there. And I think Korea, Taiwan, all three of those countries are actually coming out of the gates pretty decently this year. And they're hoping the U.S. economy is going to continue to heal. They have strong ties to global exports. They continue to work well with China and be very involved in Asia's overall growth story, and yet they weren't hot in the last couple of years. The money went to China, to India, to Southeast Asia. And so there's a lot of value in those markets, and I think that just from a general sort of where is the money moving, people are shifting around. They don't face the vulnerability to the inflation that you may see in the less developed countries. So there's a natural shift in that direction. It's not a time to come running into Asia and establish big positions and expect wonderful returns. I expect markets to be volatile. I expect there to be winners and losers in this sort of environment, and perhaps North Asia, which has lagged behind
Japan.
I think Japan is really interesting on a bottom-up basis. Japan Inc., the country, has just failed to evolve with the world. And from the tremendous pinnacle that they enjoyed 20 years ago, they have really lost it. And they still have not been able to look in the mirror and say, what are we going to do with it? Individual Japanese companies can be extremely high quality, well managed, deliver great products globally, and that's what we tend to look at. I was just talking to our Japan manager last week, and he's going, I never tell anybody to buy Japan. I just say, buy Japanese companies. That's what we're after. The individual, there's thousands of stocks there, and so you have a tremendous opportunity to find good companies.
China. Is China now too big to fail? When you compared, you said Japan 20 years ago.
Right.
Everyone thought Japan was going to take over the world. It was unstoppable.
Right.
And now we're looking at China, and it seems like it too is unstoppable. It seems like the engine of growth not only in Asia but for the rest of the world.
Right.
It's overtaking us by all sorts of different measures. How unstoppable is China?
Well, China could fail for lots of reasons. Social instability, the rural-urban structures are very difficult. Managing China has always been a huge challenge, and it will remain a huge challenge. But it isn't a bubble, I would argue. That there's overheated property markets in China, but it is a huge nation with lots of different economies. And you have individual pockets where things are speculative and there's a lot of bad investment, but then you have lots of areas where things seem to be growing at a reasonably healthy clip. Importantly, people have to put down large deposits when they buy houses and apartments. You put down usually about 40%, and they've been ranking these up. And a lot of people put down 100% and never take out a mortgage because they don't want the debt. So you still have, on a personal basis, a debt-adverse, pro-savings society. You combine that with just an enormous amount of business activity. And small business, is huge in China. Little micro businesses, I think, really are what keep the economy stable.
Unlike Japan.
Unlike Japan,
Right.
where you had these gigantic, the keiretsus, which Korea emulated and then went down the tubes, much like Japan did. And so I think China's economy is much more diverse, much more fragmented, and that the overall management of the Chinese government has one thing in mind, and that is survival. They want to stay in power as long as they possibly can, and that means stability. And I will say, I think they have a pretty good chance of managing something of a soft landing in their economy. They've got to take a lot of money out of circulation. They're going to keep raising interest rates. They're going to keep jacking up a number of their things that will cool markets in China. That's healthy. That's good. They are aiming for growth that they can maintain. Whether it's 7, 8, or 9% doesn't matter too much to me. I don't think it matters that much to them, but it's very healthy growth, and I think that's going to continue.
So how do we as investors, American investors, invest in China's growth? If in fact, the GDP is going to be, higher than
Right.
certainly than the developed world, if it is going to be an engine of growth. So what are the best ways to invest in that Chinese growth? It used to be that you said you invested through companies that did business with China. Is that still the case?
Well, that is still the case,
Yeah.
and that's perfectly valid. But I will tell you, the range of companies available in China today, many of them listed in the United States, but most not, is wide-ranging from highly speculative and really scary to well-structured professional companies with long-term track records. And the company I was going to bring up today,
right,
which is
for the one investment,
the one
long-term
investment
diversified
for me. After
portfolio.
I looked around the region, and and China Mobile was a stock that I got right a number of years ago when post the tech boom, it had really fallen out of favor. It had been the original big China blue chip, and it was a huge part of the index in the late 90s. It crashed with the whole tech sector and 3G taking a lot longer to come through than anybody hoped, and massive investments. It then had a wonderful run-up for about 5 years before the crisis. It was clobbered in the crisis, fell by roughly 50%, and it really hasn't come back at all since then. It has been out of favor because the growth in the sector has slowed. Mobile phones, there are almost 800 million mobile phone users in China today. China Mobile has almost 400 million of them. Competition is intense. Aggressive competitors force them to constantly invest in advertising and new systems and nice little campaigns to get people to hold onto their handsets. But I've known the company really since the listing. Very professional management, very straightforward. It's trading on 11 times earnings with over a 3.5% dividend, and it is really, in my mind, just this giant, stable Chinese utility. This is something China can't live without. Most rural Chinese will never see a fixed line telephone. Right. It's all mobile, and urban China is rapidly going to move into a 3G and eventually a 4G world.
And China Mobile will be there.
And China Mobile will be there. And the market is very concerned, and their own new CEO just got up and said, you know what, it's going to take us a lot longer to make money on this than some people are saying. So I like it when a CEO gets up and says, don't get too enthusiastic. There's no quick fix. We're not going to return to some high earnings growth path. But on the other hand, I think you have a very stable, very central company to China's economy that has been very well managed overall for a significant length of time. And for an American to make a single company investment, this is the kind of company that I think you can sleep at night, that will be there in 20 years. And I think that this is a great time to buy it, given its underperformance relative to the markets.
One last question. Going back to how Americans approach international investing, one of the things that we hear from money managers is that, well, you're already invested internationally because you own the S&P 500. If you own the S&P 500, 40% of their revenues come from overseas. And you're saying that does not mean you're internationally invested. Why not?
Well, 40% of an Asian company's earnings can come from the United States. It is a global economy. So there's certainly a truth to that. But I heard that argument a lot in the late 90s. You get all this international exposure from owning these great U.S. multinationals, and they're the best managed companies operating in the best regulatory environment. This was before the tech bubble burst, before Enron and WorldCom collapsed, and before we had to face the realities that I think we've had to face over and over again in the last decade, that we are not the perfect environment that we sort of imagined ourselves to be after a sustained bull market. And look at what the S&P has done in the last decade, which is not a reason not to own the S&P 500, but you simply did not get the diversification effect that a lot of people told you would get, that domestic companies, and I don't have a study to prove this, but domestic companies are still, even if they have significant overseas exposure, are driven by their local market, are driven by the sentiments of the investors. If they're locally, they think very locally. If they're internationally, they're still placing you within your country. And it is hard for Americans to understand that we really are a small part of the world. We're only 6% of its population. And people are going to view our economy as one choice within many. And I think that trend is going to be unstoppable, that the opportunities in other markets are going to continue to expand and be more reasonable and institutionalized. The U.S. economy is going to have to face a world that is catching up with it in many ways. Doesn't mean we're not a great place to invest, doesn't mean the S&P might not have a terrific 10 years. I mean, there's a lot of logic to saying, hey, it's underperformed, maybe the next decade will be a great one, but at the same time, the global economy has changed so much, we really have to wake up to the diversification that's available to us. And the last thing I'll say is that stock investments are often your only true international diversification. Your house is in the United States. Your job is probably with a U.S. company. We all own muni bonds and U.S. treasuries. Right. We're all paid in U.S. dollars. We have enormously concentrated exposure to our own economy. generally a good thing in the last century, but your stock portfolio is one place where you can get exposure to other economies and other currencies. So why wouldn't you emphasize that?
Very good point. Mark Headley from Matthews Asia Funds, thank you so much for joining us on Wealth Track.
Thanks so much for having me.
And with that sage advice, we will wrap up this edition of Wealth Track. Next week, we're going to tackle a retiree's worst nightmare, running out of money. We're going to be joined by two retirement planning pros, Kiplinger's Kim Langford and New York Life's head of retirement income security, Chris Blunt. They will have strategies to ensure our nest eggs last as long as we do. Until then, to watch this program again, please go to our website, wealthtrack.com, to see it as a podcast or streaming video. And while you're there, check out our new Wealth Track app so you can tune in on your smartphone or tablet wherever and whenever you choose. Thank you for watching, and make the week ahead a profitable and a productive one.